Welcome to The Explainer. Our goal here is pretty simple. We take complicated stuff and make it super clear, something you can actually use.
All right, today we are prying open the playbook of the absolute pros, the world's most successful investors. We're going to build a mental toolkit together so you can start thinking and acting just like them. Forget the simple stock tips. We're digging into the real principles of building wealth. So here's our game plan. First, we'll talk about the two very different games happening on Wall Street. Then we'll go on a hunt for these so-called alchemist managers. After that, we'll figure out how to spot a great business with a moat and what to pay for it. Then comes the fun part, the special moves the pros use to find hidden gems. And finally, we'll wrap up with maybe the most important piece of all, the mindset of winning by not losing.
Okay, let's dive right in, because honestly, this first point, it's the foundation for everything else we're going to talk about. See, on Wall Street, there are two completely different games being played at the same time. And if you don't know which one you're playing, you're in for a world of hurt.
So, one of these games, speculation, is kind of like this bizarre beauty contest. And in this contest, your job isn't to pick the person you think is the most beautiful. Nope. Your job is to pick the person you think everyone else, the majority of the judges, will pick. You see the difference? You're not judging beauty, you're judging the judges. And that, right there, is speculation. It's all about guessing what the crowd is going to do next.
And this slide just lays it out so perfectly. It really gets to the heart of the two mindsets. The speculator, they're obsessed with the stock, the little ticker symbol, the up and down wiggles on the screen every day. They're basically trying to outsmart the crowd. But an investor, they see that ticker symbol as just a placeholder for a real, living, breathing business. They're not buying a piece of paper, they're buying a tiny piece of an actual company.
So this brings us to a super important idea for any investor, intrinsic value. And look, this isn't some magical, unknowable number. It's the real nuts and bolts value of a business. It's based on what the company owns and, this is the big one, how much cash it can spit out for its owners from now until, well, forever. The stock price can go on a wild roller coaster ride around this value, but for a true investor, intrinsic value is the anchor. It's gravity. It's what's real.
This Michael Jordan suit analogy is just brilliant for explaining this. Okay, imagine you have a contract, a piece of paper that gives you the right to buy an actual suit worn by Michael Jordan. It's been verified it's worth $5,000, but your contract says you can buy it for just $1,000. Now, you don't even have the suit yet, but what is that contract worth? Well, it's worth $4,000, right? Because it gives you the power to instantly make a $4,000 profit. That's its intrinsic value. And really, investing is all about finding those kinds of valuable contracts in the stock market.
Okay, so once you've got that investor mindset locked in, your whole perspective shifts. You stop chasing hot stocks, and you start searching for something way, way more valuable. You start looking for brilliant people, amazing business operators, the ones who actually create the value in the first place.
You know, author Christopher Mayer just nails it with this quote. He says, "The people running the show, the management, they are the alchemists." Think about it. You can have a fantastic business, but if you put mediocre managers in charge, they can run it right into the ground. But a good business in the hands of a truly great manager, that can become a legendary, life-changing investment. They're the ones who can spin straw into gold.
So how in the world do you spot one of these alchemists? Well, you look for managers with serious skin in the game. That's just a fancy way of saying they own a big chunk of the company themselves. When someone like Jeff Bezos owns 12% of Amazon, you better believe his interests are lined up with yours. He's not just thinking about the next quarter's earnings report. He's thinking about where Amazon will be in 10, 20 years, because that's where his own massive fortune is.
And on the flip side, here's a huge red flag to watch out for. You look at who the biggest owners of a company are, and you see it's all these giant institutional funds. A lot of these guys are just tracking an index or chasing short-term momentum. They often don't understand the nitty-gritty of the industry, and they're way more likely to panic and sell at the first sign of trouble, just like the rest of the herd. You want owners who are experts in the business, not just experts in trading stocks.
So, finding a great manager, an alchemist, is step one. But what's step two? You got to make sure they're ruling over a fortress, a castle with a massive, uncrossable moat. In business speak, we call this a durable, competitive advantage.
This analogy is great. Think about football, or soccer for that matter. Anyone can start playing. All you need is a ball. The barrier to entry is basically zero. So what happens? The competition is absolutely insane. Now, contrast that with something like slalom skiing. You need crazy expensive gear, you need access to a mountain, you need a ski resort. The barriers to entry are just massive. And the result? Way less competition. As an investor, you want to find the business equivalent of slalom skiing, an industry that's super hard for new players to get into.
Okay, so let's say you've done it. You've found a great business with a wide moat, and you've got a genius alchemist running it. Now comes the million-dollar question, or, maybe the billion-dollar question. What's it actually worth? What's a fair price to pay for this thing?
And this right here is where you have to completely 100% ditch that speculator brain. I mean, think about it. If you were going to buy Nancy's ice cream stand down the street, you wouldn't just throw money at her, you'd do the math, right? You'd look at her sales, the cost of the ice cream and cones, her rent, her payroll. You'd figure out how much profit she's making before you even thought about making an offer. Well, buying one share of stock is the exact same thing, just with more zeros. You are buying a business. You got to do the work.
All right, now we're getting into the advanced section of the playbook. Once you've got the basics down cold, you can start looking for amazing opportunities in these overlooked corners of the market, the places that most people think are too complicated or, frankly, just too boring. And that is exactly where you can find incredible value hiding in plain sight.
And just to give you an idea of how powerful this can be, the legendary investor Joel Greenblatt pulled off a mind-boggling 50% return per year for a decade. I mean, do the math. That turns $1,000 into over $57,000. It's insane. And a huge part of how he did it was by mastering these kinds of special situations.
So, one of the most reliable and profitable of these special moves is called the spin-off. Here's how it works. You've got a massive company, like a giant conglomerate that does a million different things. It decides to take one of its divisions and, poof, turn it into a brand new, totally separate company. Then it gives the shares of this new little company to its existing shareholders. And all of a sudden, this new, smaller, often misunderstood company is out there trading on its own.
And what happens next is just incredible. The data is pretty clear. Over a 25-year period, these new spin-off companies, on average, beat the S&P 500 by about 10% a year. Now, why does this happen? Well, a lot of the big funds that own the giant parent company aren't allowed to own or just don't want to own the new, smaller company, so they sell it no matter the price. This creates this artificial selling pressure, and it can create a fantastic bargain for investors who are actually paying attention. It's like a built-in sale.
Okay, let's bring it home with the last and maybe the most important tool in the entire playbook. And it's not a formula or a strategy, it's your own mindset. Because in this game, your behavior, your psychology, is so much more important than your IQ. How you think is literally everything.
So, when you look at the absolute legends of investing, the Buffetts, the Mungers, the Howard Marks of the world, how do they actually play the game? What's their core philosophy?
Howard Marks has this just brilliant analogy from tennis. He says in professional tennis, it's a winner's game. The pros win by hitting these unbelievable lightning-fast shots that no one can return. But amateur tennis? That's a loser's game. The winner is usually just the person who makes fewer unforced errors. They don't have to hit amazing shots, they just have to keep the ball in play until their opponent messes up and hits it into the net. And for almost all of us, investing is the amateur's game. We win by not losing. That means your number one goal isn't to hit massive home runs every time. It's to avoid the big, stupid, catastrophic mistakes that can wipe you out. It means you focus on playing defense. You do that by always demanding a margin of safety. That's buying the $5,000 suit for $1,000, giving yourself that huge cushion for error. And it means being incredibly patient.
You know the baseball legend Ted Williams, the last guy to hit over .400 for a season? His secret was amazing. He had the strike zone mapped out in his head into 77 little squares, and he knew his exact batting average for a pitch in each one of those squares. And his rule was simple. He would not swing unless the pitch was in his sweet spot. The greatest investors are exactly the same. They don't feel the need to swing at every opportunity that comes by. They just wait and wait and wait for that perfect fat pitch right down the middle of the plate.
So what is the most crucial takeaway from this whole playbook? I think Warren Buffett puts it better than anyone. He says you should invest like you have a little punch card with only 20 slots on it. And each time you make a new investment, you have to punch a hole. And you only get 20 punches for your entire life. Just think about that for a second. How much more careful would you be? How much more research would you do? How absolutely certain would you want to be before you used up one of those precious slots? That kind of intense discipline, that forced focus on only your absolute best, highest conviction ideas, that is the real secret to winning the game.